Welcome everyone to our webinar on mitigating risks when buying a business. Apologies for the slight delay. We're just sorting out some technical trouble, but we're here now and ready to go. So my name is Bianca Reynolds and I'm a practice leader in LegalVision's corporate team. I'm joined today by my colleague Matt DeRusha, who is a senior lawyer in our corporate team, and by our co-host Warrick Oakes, who is a director in corporate advisory for HLB Mann Judd. So before we begin, a couple of quick housekeeping items. So you'll be emailed a copy of this webinar recording. Please submit your questions in the chat box as we go throughout the presentation today, and please complete the survey after the webinar as well. All attendees are eligible to receive a free legal consultation with us to discuss how we can help you with buying a business or any of your other legal needs. To request your free consultation, provide us with your contact details in the survey that appears at the end of the webinar. So today we will be discussing the first steps as a buyer, agreeing on the commercial details with the seller, due diligence, protecting your business value, contractual protections, avoiding overpayment, and then key takeaways. At the end of the webinar, we will be answering some of your questions. So please submit your questions throughout the webinar using that chat function, and we will answer them at the end. And now Matt will kick us off by looking at the first steps to take as a buyer.
Perfect. Thanks, Bianca, and welcome all. So clearly, in terms of buying a business, one of the main steps is actually finding the business you're looking to purchase. Now, in terms of where and how you go about this, there's obviously a couple different options, and we've outlined this into two categories at the top there in terms of on-market and off-market. In terms of on-market businesses, these would typically be advertised by business brokers or on other listings, and we'll have more complete information about the business, sometimes coined an information memorandum, contains key details about the business, financials, and other information. Now, it's helpful to note that sometimes, or most common, that this information is prepared in a most favorable light, because obviously they want to make the business look very attractive. So that has to be taken into consideration when viewing all of the details in that information memorandum. In terms of off-market, this is a bit of a nebulous term, and this is where you would be looking to engage someone such as Warrick to assist you in approaching businesses that aren't for sale in terms of being advertised as such. Now, in terms of how you go about this, clearly there would need to be an approach to the business, probably through a M&A advisor, and you'd be looking to obtain information about that business on a as requested basis. This might give you a more authentic view of the business, as the details haven't been kind of tabulated with a lot of time to spare, and so that's how you go about it. And then when you're actually looking at the business, you need to think about the value of the business and what you're actually paying for. So this obviously needs to be catered to the specific type of business. So a common model these days, obviously a subscription business. Clearly the value is in the value of the contracts of locked-in customers over time. And so there we would tie that into the due diligence discussions later, but we'd be looking at those contracts to make sure that those are all up to scratch. And you'd need to consider if this business is commercially, legally, and financially suitable for you. So this covers a wide array of things, including, your expertise, any licensing requirements, and other, necessary elements to actually run the proposed business. And the last part here is in terms of engaging a specialist or specialists. What we see as a key pitfall of buyers is not engaging specialists earlier, whether that's, mergers and acquisitions advisors such as Warrick or lawyers such as ourselves, to make sure that the discussions are guided by advisors early on. Because once you set the path in terms of these commercial discussions, it's hard to stray from those, and advisors might have chosen to advise on an alternative route. So we can go over the structure of the purchase, which Warrick will go into later in terms of extracting the value from the business, as well the type of sale. So this can be an asset sale or a share sale. Just to cover this off quickly, an asset sale or business sales, sometimes described, is where a company will sell the assets in the business to another company, and so there's a new owner, like company B. In terms of a share sale, this is slightly different, as the shareholders of the company, company A, are simply selling their shares to potentially you as the buyer, and you're taking over control and being appointed as a director of that company. So that'll be tied into kind of the discussions we have later on. Now Warrick will take us through a couple different types of buyers and the key considerations. Oh, we can't hear you, Warrick.
Oh, I think we've lost some sound. Apologies, everyone. Bear with us. Okay, looks like we're still having some trouble hearing you there, Warrick. Okay, nothing yet.
Maybe what we can do is skip down to your due diligence part, Bianca, and start going through that.
Yeah, sure. Sounds great. Okay, so I think what we'll do is we'll just move on to due diligence in terms of the legal side of it, and then we'll come back to Warrick's section in just a moment when we can sort out the audio issues there. So what is due diligence? So just really quickly, and Warrick will go into this in a bit more detail shortly, but it's the process where you're looking to make inquiries with the seller about the business, to validate any representations and assumptions that they're providing to you. So from a legal perspective, due diligence is really important because it helps you understand, the risk profile of the business and uncover any skeletons lurking in the closet. So the nature and the scope of due diligence that you do really depends on the type of business and the company. However, there are always key legal elements to consider, which I'll run you through now. So the first one is corporate governance documents. So really looking at the record of that company on the Australian Securities and Investments Commission website. So this first item is particularly important in the share sale context. You want to know what the asset record says about the company in terms of who the directors are, who the shareholders are, and does that align with the company's corporate records, such as their members register. You also want to know if there are any approvals or processes that need to be followed under the Constitution or any shareholders agreement in order for you to complete the transaction, and also to get an understanding of any strange or unusual terms that might be within those documents that you'd be taking over or that you would look to change once you've completed the transaction. So security interests on the personal property securities register. So this is essential in both a business sale and a share sale context as it relates to any encumbrances that the seller may have that could impact on their ability to sell you the business or their shares. So generally, banks, equipment providers, stock suppliers will often have registered security interests, and depending on the type of security interest, it may need to be released before you can obtain ownership and then legal title to the underlying assets. So litigation searches, these are usually done in the courts where the business operates and also, the location where it was established. So it's essential for a share sale, but also important in a business sale context so that you can understand, what litigation might be on foot that could impact the sale. So you'd want to find out the nature of the claim, the context, the likelihood of success of the seller in defending that claim, and to know whether you're going to be on the hook to settle that claim if it doesn't settle before completion of the transaction. Employment contracts. So it's essential whether in a business sale or a share sale, to understand the terms of employment that each of the employees are subject to that you might be looking to keep on once you take over that business. So that would include, commercial details like working hours, salary, role and responsibilities, but also issues that have a legal element too. So that includes things like leave entitlements, any restraints or non-compete clauses, confidentiality and intellectual property protections, and whether any employees are subject to any awards. The material contracts, such as customer and supplier contracts, and then property leases can also be extremely important as well, depending on the nature of the business and the industry that it operates in, which Matt will talk in a bit more detail about shortly as well. So ultimately, you want to make sure that the big picture of the business, when you factor in all of its assets, its liabilities, the risks and the potential for growth equate to the purchase price that you are willing to pay for it. So Matt will talk us through some key things to consider when looking at how to protect a business's value, and hopefully we'll sort out the issues with Warrick's connection, and then he can go through some of his points there as well. So over to you, Matt.
Sorry, Bianca, Matt, I'm actually back just on my mobile phone. Apologies about that. So happy to go over the slides from then, or we can go with Matt.
Fantastic.
Maybe I'll
Okay.
I'll go over my protecting the business value, and then we'll flip back to you, Warrick.
Brilliant, thank you.
Yeah, perfect. Glad we got that sorted. Thanks, everyone. So thanks for that, Bianca. So I think in terms of protecting your business value, we're kind of thinking about this from a legal perspective. We'll go into a bit more detail around due diligence, but really there's two sides to protecting your business value or protecting the value of the business you're about to purchase. That's conducting due diligence, so finding any skeletons in the closet, and then as well in terms of the business sale agreement, addressing those concerns or putting protections into there. So we'll go through a couple key things, noting that it can be kind of uncovered and then addressed later on as well if there is issues. The first key point here is what are the key client contracts and are they locked in? So in terms of the business, this will obviously depend on what type of business we're looking at. But if it's a contract-based business, we want to make sure that they're locked in. We've reviewed those contracts. There's no red flags. So obviously a key thing would be termination rights under those contracts. Can the client simply walk away? In terms of like a gym or something, for some contracts, these clients are locked in for a year term. Otherwise, they're only locked in for month to month or not locked in at all. So you want to know that before you kind of lock in a purchase price and give kind of, the value to that business. So, and then if they are locked in, can those contracts be transferred? Or can they be novated? These are two kind of legal terms that you don't need to worry about too much, but essentially we can deal with these in different ways, and the contract will set out the specific requirements of these transferring these contracts. In terms of the business IP, now this is crucial for most businesses, but is more so crucial for some businesses as opposed to others. Obviously, if there's a software-based business and you have developers engaged as employees, you want to make sure that the company owns that IP and that you as the buyer will get credit and the the ownership of that IP moving forward. So essentially with most IP, you need to kind of follow the chain of ownership, being that where an employee is creating that IP, you want to make sure that the employee is then assigning it or transferring it to the company, and then that sits with the company as part of the business sale. You're actually acquiring that IP, or through a share sale, it's still sitting with the company. Same goes for contractors. Are they doing anything that's crucial to the business? We want to check those agreements to make sure that the IP is being transferred to the seller company. In terms of key workers, obviously it's common for businesses to be kind of what's coined under management. So under that scenario, we want to make sure that there's key workers and managers that are being retained after completion of the sale. So completion is the part where you've paid the purchase price and the business transfers over to you. We want to make sure that those workers are going to be signed on with the business, whether as employees or contractors, and they'll stay with the business to make sure that it continues to run smoothly. And as well, we want to keep employees motivated. This can relate to key employees or employees generally. Most of the time, buyers will want to keep most of the workforce, and so we want to make sure that the sale is looked at favorably, because clearly a business sale could be a change of management, and employees could be looking to jump ship because of this. So this is all built into some of the processes in the business sale agreement and how it's dealt with. And in terms of the final point there on the slide, that's whether the business is a premises-based business, whether it has a physical location, and whether that's important to the ongoing operation. So if it is, clearly we're looking at the transfer of that current lease or entering into a new lease. As part of that, we would be either reviewing that current lease or the new lease to make sure there's no red flags. So these could include, demolition clauses, or make good obligations, which is common that at the end of the lease, you as the tenant have to actually make good the premises and put it back in its previous state. So that can be quite costly. And so where the lease is assigned to you, that obligation can be shifted across to you. So it's good to know about that before you enter. Clearly as well, being on board with the key commercial terms in terms of rent, outgoings, and the actual term or length of the lease is crucial as well. So just to wrap up here on the protecting the business value, one of the key ways that we can actually deal with some of these key aspects is by including these in the business sale agreement as what's called a condition precedent, or it's something that needs to happen before the sale can complete. So that can include the transfer of key contracts, the transfer of IP, workers signing new employment agreements with the buyer, with you, or the transfer of the lease. And so these things would need to happen before the sale can actually complete. So that's a good way to protect these key elements. So I think in terms of the next slide here, I think we'll be going back up to first steps as a buyer, and Warrick can take us away there.
Great, thanks Matt, and apologies everyone for those technical issues. Yeah, the next few slides will basically set the scene about what we're looking to buy a business and how we go about doing it. So yes, so typically there's 4 broad groups of buyers. We have strategic, a financial investor, personal investor, or a management buyout. Whilst the strategic intent is for each of the groups may be different, there's obviously benefits, and high-level transaction process will remain the same across each group. So the first step is obviously to be aware of the advantages in acquiring a business, and then determine if the transaction will, number one, accelerate the growth. Typically, as you'll get access to new markets, new customers, suppliers. You'll also get improved negotiation ability with some of those suppliers. You should expand your knowledge and grow the staff skill set. In most deals, the buyer will look to gain control over operations and obviously influence positive change. Buying often gives you the opportunity to gain some synergies and grow the overall business value. And then ultimately, the acquisition may also increase the opportunities to exit the business for a higher value in the future years. If you can, next slide, please. Great. So once you understand all the value proposition, and like what you've seen from a prospective seller, then what are the next steps? So we always recommend formalizing negotiations in some form of a document. So these are often called a non-binding indicative offer, a letter of intent, or even a heads of agreement. In a non-market transaction, which Matt talked about earlier, there's often going to be a set format which the which the advisors will insist upon, just to make it all comparable for sellers. We'd also recommend documenting commercial details for both on-market and off-market approaches, and we'll go through some of the things we typically expect to see in the letter of intent, head of agreement, or term sheet. So as a buyer, you'll need to first consider the deal structure, which is all designed to reduce possible risks. So be aware of what you are buying and what entity is going to be making the transaction. So this could include setting up a new top company, but engage with experts to confirm the best approach before doing that. Also understand what is being bought as part of the transaction. So typically consider, is it a company, the business and its assets, buying out individual shareholders, or dealing with trusts? There's often different tax outcomes, so by considering the structuring consequences early, you can significantly improve deal outcomes for all parties, and may also impact how the transaction will be funded. Always be upfront. Deals need to work for both parties, so agree on the headline structure for the transaction. Be open about what is being acquired and how key obligations around staff, customers, and suppliers will be treated. And bring them into consideration. They're all critical elements and will all be negotiated as part of the deal. Valuation. So be clear on the valuation approach. Naturally, it's a start point of any deal, so the seller will be taking advice on acceptable valuations from many places, so it will always need to be realistic. In an off-market deal, you may not have seen any financial information, so agree on a method. This will be shored up during the due diligence phase, and we'll discuss this all shortly. And then determine how the purchase consideration will be paid. We've typically got upfront amounts and then amounts that are deferred, and will also be covered shortly. Set out an indicative transaction timeline. This just keeps all parties honest and helps manage the risk of deal fatigue. Transactions are life-changing events for sellers, so there's always a lot of tension around. And also set out the process for the due diligence and access to further information. So once all parties have agreed to the initial commercial terms, the next step is to actually conduct the due diligence on the business or company you're looking to acquire. Great, so thanks. So what is a due diligence process? So at its core, it's a formal process where an interested buyer makes inquiries about representations, including financial, legal, and other operational matters, to validate the representations and assumptions made by a seller in relation to the business. It's never a one-size-fits-all, so due diligence should be scalable to the specific nature of the business. The due diligence process will also identify known and unknown risks and help you create a plan to overcome them. They'll assist in determining the value of the business and how much the buyer would be willing to pay for the business. Also, matters identified during this process are often used and discussed with the seller as part of the deal negotiation. And importantly, by being aware of any risks up front, the buyer will avoid some post-acquisition shocks. So those shocks are then listed in front of you there, but basically they include failing to extract value from the business after the deal's done. You know, naturally a lot can go wrong, so the buyer needs to be comfortable they're buying a business that is going to increase in value. Coupled with this, there could be the inability to transition and integrate the business after acquisition. There are many reasons for this to occur, and having a plan that covers perceived eventualities will help. Losing key staff, customers, suppliers after the acquisition are all known risks going into any deal. You can also inherit some previously unidentified risks, which could include tax. And we can go through mechanisms later on as well. In fact, Bianca's probably gone through some of those already. Sorry. In any of these were to eventuate, there's also an increased risk the buyer may need to borrow and repay some unplanned funding just for the acquisition, if there's a disconnect between planned and the actual cash flows. So a mergers and acquisition specialist will obviously approach the due diligence process in a systematic way and provide a clear report of findings that will cover, amongst other things, those potential risks that you can plan for. Your M&A lawyer will also be able to assist, and I know Bianca's gone through a few of those points with you already. So then from a presentations perspective, if we go down to where Matt was, I presume, then I can pick it up again from there. On overpayment, is that right, Matt?
Yeah, I think that should be.
Oh, slide 12, I think it is, sorry. Cool, okay, thank you. So, as touched upon, appropriate due diligence covering financial, legal, and other operational factors, as well as having a proper transaction structuring, will assist you in protecting your investment and ultimately the business value. As a due diligence process is running, buyers can further protect your investment by implementing the following key steps to a successful business acquisition. So develop a thorough strategy to understand the why buy. As you proceed through the process, you'll be able to get a head start on opportunities for post-acquisition. Continue to undertake thorough research to understand the industry, the geography, and specific risks before progressing with any deal. Prepare a business plan and a financial model, and test out any perceived future failings or other financial impacts. Buyers will also get the opportunity to plan for integration opportunities and challenges post-acquisition. Also take the opportunity to get to know the people and factors that have contributed to the past performance of the business. Due diligence serves as a great opportunity to meet and engage with some quality people, and also be realistic, and you'll maximize your chances of success. So from a contractual consideration point of view, Bianca and I'll be able to go through those with you.
Perfect. Thanks, Warrick. So, yeah, an important way to mitigate your risks when buying a business is to ensure you have those appropriate contractual protections in place. So generally, once you've agreed those commercial terms with the seller and you've done some due diligence on the business, the seller will provide you with a contract of sale. So that might be a business sale agreement or a share sale agreement and any other transaction documents relevant to the transaction. So you'll of course need to make sure that the commercial details in the contract are correct and what you've agreed to, such as the amount of the purchase price you're willing to pay. But there are a number of legal protections that you do need to make sure you have in place. So your M&A lawyer can review this contract for you and advise you on the terms that are going to be most suitable to protect you in your specific transaction. So we'll go through some common key legal points now that we will always flag with our buyer clients. So the first one includes warranties. So these are promises or assurances that are given by the seller to you about the business or the company. So they provide you with a method of protection and recourse if unknown liabilities arise after completion. So some key warranties will cover, material areas of risk such as, legal title to the assets or shares, material contracts, and the financials. And essentially, if the seller has promised something that as at the date you took over the business was true and accurate, and then after completion, you discover that that promise couldn't have been true or accurate at the completion date, you could look to make a claim against the seller for any loss that you suffer as a result. So indemnities, so these are obligations by the seller to reimburse you for a specific liability. So they can provide greater protection than warranties in some cases because you just need to prove that you've suffered a loss. You don't have to go through the process of making a claim against the seller for breach of the contract as you do with warranties. So because of this, sellers can be more reluctant to provide indemnities, so they're often used to protect against a specific risk that you've identified in your due diligence. However, best practice from a buyer perspective is to always try and include a general indemnity to support the warranties. But if the seller won't agree, then you can just focus that indemnity on specific areas of risk for you. You should also think about how you're going to recover any loss you suffer if you need to make a warranty claim or seek reimbursement under an indemnity. So if the seller is selling you their entire business, they might not have any valuable assets left after completion to satisfy any claims that you want to make. So this is why it's important to consider if you should request a personal guarantee from the seller in respect of those warranties and indemnities. So for example, if a company is selling you the business or the shares, you could request a personal guarantee from the director of that company, and that way you'll have recourse to their personal assets if the company won't have any assets after the sale completes. The next point here is restraints of trade. So you want to make sure that the contract of sale includes a restraint of trade, or it's also called a non-compete. So that will prevent the seller from competing with the business after you've taken over. we usually cover a certain geographical area, a certain time period, who it will apply to. So it should apply to the selling entity and any relevant key person like the director. And it will set out the type of business and activities that the seller is prohibited from doing. So generally, whether or not a restraint of trade is legally enforceable depends on the facts of the situation. So it is important to consider what's reasonable and what you genuinely need to legitimately protect your business interests when asking for a restraint. And finally, another mechanism you can use to protect you in the transaction and help to ensure that you're paying a fair price for the business are earnouts, retention payments or escrow arrangements, and purchase price adjustments. So these payment structures can be particularly helpful if the seller is unwilling to provide a personal guarantee, or if the value of the business is predominantly based in goodwill and intangible assets, which can be, harder to value. So Warrick will take us through the payment structures in a bit more detail now. So over to you, Warrick.
Great, thanks, Bianca. Yes, so just avoiding overpayment basically is a good way that contracts can help. So some of the strategies that we can adopt to try and avoid overpaying would include taking the time to understand the objectives of the seller. So if you can work something out which is beneficial for both parties, particularly tax outcomes, which we'll cover off a little bit later on the slide. So structure a deal that aligns with your strategy to extract the optimal value. So you may be able to align the payment of the purchase consideration with when you expect to receive some of the benefits of the transaction, which include your free cash flows. So as Bianca mentioned, this is called an earnout, and it's linked to either time, performance, or any other combination of measurement. So the earnout mechanism will allow you to potentially also allow you to potentially lock in management, the talent, align your strategies, which would obviously include your growth. Obviously conduct appropriate due diligence to mitigate future risks and any liabilities, and also negotiate. All deals are negotiable, and as that can be very stressful events, we often find engaging with an M&A specialist who can act on your behalf provides the buyer protection from being seen as a bad guy in the process. So as touched on above, a point to be aware of from a potential earnout mechanism is from a tax perspective is that it's recently changed. So previously, an earnout is the deferred payment of the purchase price and was taxed in advance. So basically, you were taxed on amounts which were not yet received. However, there has been a change in the tax law that previously required those earnouts to be taxed up front. So now the change has been that qualifying earnouts are taxed on amounts received and when they are received, but there's a bit of complexity about meeting qualifying conditions, so seek out specialist advice. Now, it's more likely to be fair, but it's a little bit less certain for a seller. So it's always going to be a balancing act and will be negotiated. So from a key takeaways perspective, so just to close, a few key takeaways of successful transactions that we see. So look to engage with specialist professionals early so you can maximize efficiency through a deal. There's various specialists available, and at a minimum, mergers and acquisition accountants and lawyers should be engaged. They'll be a great resource to help negotiate a fair deal and will reduce the stress which is inherent in any deal. And remember, it's a scalable, due diligence is scalable, and there is no one-size-fits-all approach. Be prepared to negotiate up front and document this in your first formal interactions. It makes it a lot easier before significant costs have been incurred and stresses eventuate. And also, earnouts can protect exposure as you can link future payments to unlocked future benefits of the transaction and the post-acquisition integration. Thanks, everyone. That's all for me. Matt, over to you.
Yeah, the last 2 points on that key takeaways one was just around the other key takeaway of mitigating risks via the transaction document. So as Warrick has explained, we obviously want to conduct targeted due diligence, and then we want to address those risks in the business sale agreement by the mechanisms that Bianca's gone through. And then as well, structuring a favorable deal, which we've just kind of gone through, making sure you extract your value out of the business before you pay the full purchase price. So the key way is deferred payment or earnouts, as we've just gone through. So that that concludes the formal segment of this presentation. We have a couple kind of key little info graphs here, and we can then get to the questions. So if you're interested, we also have a guide on negotiating terms, and you can access this handout in the handout section of the webinar panel and download it now and have a flip through that. We also have another upcoming webinar, and we're doing quite a few of these, so look out for those notifications. The next one is on tips for terminating commercial contracts. Clearly a key one for most businesses to know when you can or cannot terminate contracts and what the implications would be. So that's on the 17th of November on the Tuesday. And the last portion here is as well becoming a member of LegalVision. So if you're not aware, LegalVision is a member-based legal service provider. Essentially, we have a membership called LV Connect Pro, where we try to service all of your day-to-day legal needs on an all-inclusive basis. And so there's a couple kind of key parts here, including unlimited document reviews, unlimited legal advice consultations, so you can book in calls directly with a lawyer in any of our specialist team, in various kind of calendar slots. And as well, we have quick turnaround times and affordable weekly fees, and over 100 plus in-house lawyers in the various teams that we have. So get in touch. We can have a free legal consultation with you, discuss these benefits and how we might be able to help.
And thank you, Matt. So if you've got any financial or accounting queries, feel free to reach out. As noted on the slide here, I'm a director at HLB Mann Judd here in Sydney. The team I work in specialises in transactions and includes buying and selling of businesses, raising capital, and any capital market transactions. With 180 staff here in Sydney, we provide all the advisory and traditional accounting services needed to help our clients through all stages of their business life cycle. We're also part of the HLB Mann Judd Australasia network and the HLB International, which is a global advisory and accounting network with thousands of staff operating in 157 countries. So if you come across any opportunity or would like to find out any more about how we may be able to help, please feel free to get in touch, and I always welcome the opportunity to talk.
Okay, great. Thanks, Warrick. Thank you, Matt. So now we'll answer some of your questions. I'm just having a look through our chat box now. So we did have one question come through where there's two owners, partners, one working within the business and one a non-working director, seemingly having different views and wanting to sell, and they want to buy. So Warrick, I might hand this one to you. I think you might have some good points there in terms of, advising on the corporate strategic transaction approach there. And then I'm happy to provide some comments from a legal perspective as well.
Great, thanks, Bianca. Yeah, so often this is obviously a bit of a complex matter where you've got one person who's, benefiting from someone else's work. Often it's a lot easier for an advisory firm like us to get involved because we can naturally approach the target and see if there's actually an opportunity to do a deal. We can act initially on a no-names basis. We'll be upfront that we're helping a business explore opportunities and they've come up as a potential option. Everyone likes to be flattered with the potential approach. The other benefit here is that there's a natural conflict, as I mentioned, between the owner who's not working in the business and benefiting from the hard work of the others. So a skilled professional may be able to help uncover what needs to happen for a deal to get done. The key is obviously to make the transaction appealing for the non-working owner so they can walk away whilst keeping the working director engaged for the longer term. Bianca?
Perfect. Thanks, Warrick. Yeah, so from a legal perspective, I suppose it depends on the structure of the operating entity of the business as well. So if you operate as a company, it might be the case that one of the shareholders is looking to sell their shares to the other. If you're operating in a partnership, then you'd be looking to assign your partnership interest and then effectively dissolve the existing partnership potentially if the remaining partner is looking to bring on new partners. So there are a number of ways to kind of approach it depending on how you're actually operating that business as to what kind of legal documents and considerations would be needed to, affect that sale essentially. Okay, so I think we've only got a couple of minutes left. So we've just had one more question come through that I'll read out now. So when reviewing any outstanding litigation, how can you be assured you have captured all the litigation, i.e. there is no central registry? So really, you do need to do searches in the different courts that are ideally relevant to the business that you're looking to acquire. So for example, if that business operates predominantly in New South Wales, you'd need to do court searches of the district court, the Supreme Court, the federal court, so that you can capture all potential litigation that would be relevant to that business. You can of course do court searches in a number of courts throughout Australia, but court searches can be a bit expensive, so you at least want to focus on the main ones that are relevant to where the business is operating and where there's likely to be any potential litigation. Okay, I think that's all we have time for today in terms of questions. So don't forget to request your free consultation when the survey appears at the end of this webinar. Thank you all so much for joining us. Our apologies again for some of the technical difficulties today, but we really appreciate your time and hope that this has been a helpful session for you. So thank you again.
Thanks, everyone.
Yeah, thank you.